Welcome into another video, guys. Today I'll be explaining how to improve your analysis, how to add more confluence to your analysis to be more confident on your trades and to improve this win ratio. Alright, so we will start by reminding you that I'm trading based on supply and demand. So every example I will showcase you will be based on that, of course. Let's start with that. It's called Breaker, RP Breaker by Rect Proof, and it's a pretty nice setup to use based on also on supply and demand zones. So this is the showcase, the hypothetical scenario. We have an origin point. From there we want to see a new low. A new low forms into the chart. We have a break of structure here, forms a new low, then we have a new low deviating from the previous low. From here what we want to see, it's a swing high touching the point of origin, alright, or this zone. Mind that it doesn't need to be perfect and it won't be. And then we want to see a slow rise breaking this level, alright, like here, and then waiting for it to touch the liquidity on the breaker candle, right? This is where the big movement has been originated, right? You can go for this one or this one also, because also this one is a small rally but still good liquidity, right? And on 15 minutes I think that, yeah, exactly, this is how the trade was done. This is the liquidity on 15 minutes. As you can see, this liquidity doesn't seem very good. It's just a candle inside of free green candles. So won't take that liquidity. This will be for sure a better entry. And here you go. So origin, new low, another new low, deviation, swing high, touching the origin point, flipping it a bit. Mind that if price did not get over, have to close above the origin point, so above a closure above this, and then we wait for our liquidity to get taken. Moving forward, the next thing I will explain is Fibonacci retracement. You can find it here in the TradingView tools, how it works, how you draw it from the bottom to the top of the formation. You can count wicks, you cannot. Do what you are most confident in. Alright, and in this case we have many liquidity zones, so I will be placing for sure more orders because I don't know which one will be the liquidity zone where the price will stop into it. Alright, so we start here from the 0.5 zone. Actually, let me show you. Those are the setups that I'm using on my Fibonacci, the ranges, the zone I need. Alright, so we start from here. 0.5 zone is too early. I don't think this liquidity zone will get taken. I didn't have an order here, so we won't need that. I'm using this actually for my stops because those levels are slightly below my liquidity zones, so I can put an order here and a stop loss slightly below the 618 level of the Fibonacci, and same thing for an order here and a stop below the 0.76 level. And as you can see, this one gets stopped out minus 0.90%, and this one get not stopped out. Pretty good trade, still open, up over 4%, pretty good. You can also use the Fibonacci the other way around, starting from the top to the bottom and using it as take profit. For example, for this position right here on that liquidity zone, so this will be the 0.5, which will be already a good point, remind you that 0.5 and 0.618 are usually the best levels, and we could take some profits here. Look here, taps again on the liquidity zone, so we can add more again, or adding back what we took and the profits. 618 zone, TP2, taking some more profits, adding some more here, and going for the TP3, which would be on 686. So sorry, 786, which would be played out very nicely. I still have this open order. I'm waiting for this bigger liquidity to get filled, alright, the price to touch here. But this is how you can trade it pretty easily, or you can even go for that point right here. And the last thing for this video, the last thing I will show you is called the power of 3, and this is how it looks. So we have an accumulation zone. Let me draw it, an example, and I will explain it. So we have price ranging here, accumulating, then we get a manipulation, brings the price, drop the price, and then as soon as we exit this zone, we get expansion of the price, all right? This will be how it works. Now let's find one in the chart. This will be good. So as you can see here, we have an accumulation zone. Price accumulates in this area. Then we get a manipulation. Price drops down. Market makers exchanging their orders, filling their longs, and as you can see, even on the liquidity on the 5 minutes, the liquidity from the candle that originated this huge breaker. So I will surely go for an order here, along here. 1% stop loss would be good, being on 5 minutes, and then 3 to 1 to risk to reward, something like that. And as you can see, the expansion of the price, as soon as price closes above the previous square, the manipulation one expands instantly. And this will be the formation. Of course, we can have even the same formation, but just flipped it down, like this case right here. We have price accumulating in this area. All right, we get a manipulation of the price, bringing the price above of this accumulation, and then expansion. This is a pretty good one, pretty big one. All right, the expansion usually is 2 or 3 times bigger than the accumulation zone, so 2 to 3 times wider than that. Pretty easy to trade that. Every time you see a consolidation you go forward and you go see for good liquidity zones above and below the zone you are trading in. Price is accumulating in. Like in this case, we get nice liquidity down here, pretty close. Price can get manipulated into this level pretty easily. We have a bit of liquidity down here also, not the best liquidity. I will also mark this, but yeah, it's a breaker candle, but yeah, and in this case, as soon as price deviates and exits from this accumulation zone and gets into that level, up opening a long or a short from one of those 2 levels in the middle of the this area. All right, so we see here this one, we don't need it. We open a short right here and price drops down. Before wrapping up the video, guys, I'm just willing to remind you to keep track of your trades, keep track of your setups, and find what works the best for you. All right, put everything into an Excel, look for your win rate, look for your setup, and start to know actually what you're doing. And divide your setups in 3 categories, like this. For example, the setup C, which has the lowest win rate, is the one that I'm going with less capital in, right? 7% of my portfolio, for example. The setups B, it's a bit better, and I get a 55% of win rate, so I'm risking a bit more. And the setup A, which is the most rare to find in a chart, or I don't know, it's still the best one for me to trade, 75% win rate, so I'm going with a huge risk on that, because it's the best setup for me and works only fails 1 time out of 4. All right, so thank you for following till here, guys. See you in the next video. See ya.